Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to dive into a critical but often overlooked part of the renewable energy sector, distressed debt acquisition. This involves investing in or buying debt from renewable energy projects or companies facing financial challenges. It's a high-stakes area because it combines the pressures of debt management with the dynamic growth and complexity of renewable energy. Understanding this space gives us insight into how capital flows, risks are managed, and opportunities arise even when projects encounter difficulties. Let's explore how this process works and why it matters for the future of clean energy. Renewable energy often seems like the safest part of modern infrastructure. It has strong political support, subsidies, and fits well with environmental goals. But if you look closer, there are serious problems. Many wind farms in Europe and North America aren't operating as planned because of broken service contracts. Solar parks are losing money due to poorly structured power sale deals. Companies have taken on debt assuming everything would run smoothly and subsidies would last forever, but that hasn't happened. Not to save the green energy movement, but to carefully analyze and take advantage of the financial struggles caused by these mismatches. Their focus is on legal priorities, preventing cash loss, identifying technical insolvency, and using negotiation power. Optimism doesn't play a role here. This is about hard financial facts and risks. In this part, we'll look closely at how distressed renewable energy assets are bought at a fraction of their original cost, and how wind farms that seem stranded can actually be transformed into portfolios that generate strong returns. This process isn't about lofty sustainability claims, it's about practical, decisive action and effective management. As the power grid faces growing challenges and inefficiencies, those who execute with precision are the ones who will sustain their position in this evolving market. By understanding this, we can see what really drives success and survival in the renewable energy sector today. Distress in renewable infrastructure often starts quietly, long before any major failure shows up. Many projects don't fail because they stop generating power. Instead, the problem is financial. They can't cover their debt or meet key financial agreements. This can happen when projects take on too much debt or when the costs to operate and maintain the equipment are higher than expected. Equipment can degrade over time, like gearboxes, inverters, or blades, which further impacts performance. Sometimes the initial assumptions about wind or sunlight levels are overly optimistic, leading to less energy production than planned. Contracts to sell power may also expire or be priced incorrectly, cutting into revenue. So even if the project is still producing electricity daily, it may be technically insolvent, struggling with financial ratios and obligations that determine its ability to operate sustainably. Renewable energy projects are often funded through a complex layering of different financial players, each with their own position and interest in the capital stack. At the top, senior secured lenders have the strongest rights and demand control in times of distress. Below them are mezzanine lenders and subordinated debt holders, each accepting more risk but also expecting higher returns. Tax equity investors play a unique role, focused on ensuring the project meets the necessary compliance to capture tax benefits. Meanwhile, the sponsors and operators who develop and run the projects want flexibility and optionality to manage the asset. When a project faces financial trouble, these differing priorities, control for senior lenders, compliance for tax investors, flexibility for sponsors, clash sharply. This misalignment creates both challenges and opportunities for restructuring or acquiring distressed assets as parties negotiate their conflicting rights and incentives. Understanding this complexity is key to navigating and capitalizing on distress in renewable infrastructure. Many early investors believed renewable energy projects were safe simply because of strong regulatory support and subsidies. However, as these subsidies decrease and projects become more exposed to market forces, that sense of security fades quickly. Assets that were designed assuming stable policy support suddenly have to compete in competitive markets, and many of them struggle to cope with this new reality. This shift from guaranteed returns to market risk reveals vulnerabilities that were often underestimated at the start. It's important to understand that the real challenge for renewables lies not just in technology or finance, but in adapting to a market environment that demands performance without relying on policy protection. Investors who focus on distressed debt rather than equity do so because debt gives them real control over what happens during financial trouble. By buying the right piece of debt, they can influence how the restructuring process unfolds, force changes to loan agreements, stop recapitalizations that don't benefit them, and even initiate foreclosures or credit bids. Simply owning equity in a wind farm that's struggling doesn't offer any real power. It's more like watching events happen from the sidelines. But owning senior or well-positioned debt means having a say in decisions and outcomes, which is why sophisticated investors target debt when a renewable energy asset faces distress. This control through claims is critical in navigating the complexities of troubled renewable projects. Debt in distressed renewable projects often trades at significant discounts because lenders and investors have different reasons to exit. Sometimes banks need to reduce their regulatory capital exposure quickly. Other times, infrastructure funds want to clean up their portfolios by shedding non-core assets. This creates pricing asymmetry where the actual physical asset remains intact and valuable, but the debt tied to it is sold for much less than its original value. For example, a wind farm initially financed with 100 million euros of senior debt might see that debt change hands for 40 to 60 million euros. This discount creates an opportunity for savvy investors to acquire control through debt positions at a fraction of the asset's true worth. Distressed debt offers several unique advantages that equity typically doesn't, especially at similar entry prices. Investors in distressed debt have the flexibility to recover their investment through restructuring processes, turning their debt claims into equity if enforcement actions are necessary, or even taking direct ownership of assets through foreclosure. Once the asset or project stabilizes, there's also an opportunity to re-leverage, which can enhance returns. This range of potential outcomes provides an asymmetric upside that equity investments usually can't match, making distressed debt a more strategic choice for investors seeking control and multiple pathways to value creation in renewable infrastructure. Acquiring distressed renewable debt requires an active and highly technical approach. It's not something that happens by chance or from waiting for opportunities to appear. Experts constantly monitor a range of signals like covenant breaches, reserve drawdowns, disputes over operations and maintenance, sponsors pulling back support, expiring power purchase agreements, and even insolvency filings. They use data from public filings, lender conversations, and industry intelligence to track these signs weeks or even months before a formal default occurs. This is a process resembling financial engineering on an industrial scale, where understanding the early warning signs allows investors to position themselves strategically and act decisively in a complex market. Before investing any capital, it's crucial to break down the entire legal and financial setup of the asset. This means understanding exactly which entity owns the renewable project, where the debt sits within the capital structure, and who has control over the flow of cash from the asset. Each layer of debt may come with different types of security, so it's important to identify what protections are in place at each level. Additionally, enforcement rights vary depending on the jurisdictions that govern the agreements, which can impact outcomes significantly. Even a single overlooked clause between creditors, called an intercreditor agreement, can completely change the financial outcome and the viability of the deal. This kind of intense reverse engineering helps investors know precisely what they're acquiring and how to navigate the complexities of distressed renewable debt. Investors don't buy all the debt at once. Instead, they focus on the specific slices where leverage is highest, because these parts offer the most control and potential value. They often target junior claims that are still structurally senior, as these carry unique advantages. Many pursue loan-to-own strategies, aiming to convert debt holdings into ownership, but this outcome is never guaranteed. The process usually involves quiet, direct negotiations between parties, which can be tough and very strategic. This focused approach helps investors maximize their influence and potential returns in distressed renewable debt situations. Distress in renewable debt can't usually be fixed through financial restructuring alone. At this stage, operational intervention plays a critical role. This includes renegotiating the operations and maintenance contracts to improve efficiency, replacing underperforming operators to get better results, and selectively reallocating capital expenditures to where they can have the biggest impact. Sometimes it's necessary to extend the asset's life by making precise upgrades rather than broad renovations. This operational approach often distinguishes successful recoveries because while financial investors may struggle here, experienced operators bring the industrial know-how needed to turn the asset around effectively. Once leverage is firmly in place, the path forward is usually clear and deliberate. The first approach is debt restructuring, which often happens on terms favorable to the new investors, giving them a stronger position in the capital structure. This might involve diluting or even removing the original sponsors who are behind the project. If restructuring isn't sufficient, foreclosure becomes the next step, which typically leads to recapitalizing the asset to stabilize it for the future. After this, the asset is often sold to more stable infrastructure portfolios that are better suited for long-term management. It's important to note that the original promoters rarely stay involved in the project through this process, as control effectively shifts to those who have taken over the debt and push through these enforcement actions. SunEdison's bankruptcy created a challenging environment for renewable energy projects. Many of these projects were wrapped up in complicated financial structures, including tax equity deals, yieldcos, and layered debt. After the bankruptcy filing, investors who specialize in distressed debt stepped in, buying portions of this debt. They selectively enforced their rights to take control of the most valuable and well-performing assets, while others had to fight through legal battles to claim whatever was left. Takeaway here is that the complexity of these financial structures can intensify the difficulties in a crisis, but it also creates opportunities for those who can quickly understand and navigate the intricate details. This example shows how important it is to be both knowledgeable and strategic when dealing with distressed renewable energy assets. In Southern Europe, many wind farms were initially profitable thanks to generous feed-in tariffs. However, when those subsidies were reduced or revised, these projects quickly became unviable. Investors saw an opportunity by acquiring the debt tied to these wind farms at significant discounts. With ownership of this distressed debt, they were able to renegotiate terms related to grid access, improve how much energy the turbines actually produced, and ultimately exited their investment with returns well above what they initially put in. The key takeaway here is that what created these entry points was not that the assets themselves were obsolete, but that regulatory changes introduced volatility and financial distress. This distinction is important because it guides how investors approach similar opportunities in the future, focusing on structural and regulatory shifts rather than the physical depreciation of assets. In the US, several community solar projects failed primarily because they were not structured well. They struggled with subscribers leaving and mounting maintenance costs, which pushed the projects into distress. When debt buyers stepped in, they didn't just buy the troubled debt. They consolidated the various portfolios to achieve scale, improved billing and servicing with professional management, and ultimately restored stable, predictable cash flows. This case clearly shows that what often looks like a market failure is actually an issue of poor operational management. Correcting how these projects are run can make a significant difference in their success and financial stability. Strategic energy companies also find real value in acquiring distressed renewable assets. They can buy these assets for less than what it would cost to replace them, which is a strong financial incentive. Buying during downturns lets them expand their operational footprint efficiently. Capture operational synergies by integrating the assets with their existing operations, improving overall efficiency. Additionally, by controlling more assets in a region, they can play a significant role in enhancing the resilience of the local power grid, supporting reliability and stability in the face of challenges. This approach is about more than just buying low. It's a way for energy companies to strengthen their position and promote long-term sustainability in their markets. Financial firms benefit significantly from distressed renewable debt by generating returns that don't move in step with traditional markets, which helps diversify their portfolios. They can also turn their expertise in restructuring troubled assets into a direct source of profit, leveraging deep knowledge of the complexities involved. Furthermore, these firms can build portfolios that provide steady long-term cash yields, creating a reliable income stream that aligns well with institutional investment horizons. This approach offers not only financial gain, but also strategic value through disciplined asset management in a specialized sector. Distressed asset investors play a crucial role in stabilizing failing infrastructure, which often requires urgent attention before operations can improve. By focusing on enhancing asset availability, they ensure these assets become productive and reliable again, which benefits both operators and end users. They also drive professional governance practices, bringing better management and oversight to projects that may have suffered from neglect or poor decision-making. This professional approach helps restore lender confidence, making it easier to secure financing or refinance existing debt. Importantly, the strict discipline needed in this environment naturally weeds out less committed participants, often referred to as tourists, ensuring that only serious, capable operators remain engaged. This combination of stabilizing physical assets, governance improvements, and restoring trust creates significant practical value for businesses and capital allocators involved in distressed renewable projects. Investing in distressed renewable debt offers several clear advantages. First, it allows capital to be deployed at a deep discount, often far below the intrinsic value of the asset, which provides strong downside protection because these investments are typically senior claims safeguarding the capital. It also offers strategic control since enforcement rights give investors leverage during restructuring or operational adjustments. Another key benefit is ESG optionality. Returns can align with decarbonization goals without solely relying on those outcomes, giving flexibility. Finally, this approach is scalable, using repeatable investment playbooks that work across different geographies. Success in this space rewards patience, precision, and preparedness, making it a compelling strategy for those ready to navigate the complexities of distressed renewable assets. This strategy carries several risks and challenges that anyone considering it should understand. Legally, enforcement can be complicated by jurisdictional issues, which can delay or prevent action. From an operational standpoint, asset failures can quickly increase losses and complicate recovery. Politically, changes in subsidies or regulations can disrupt expected returns. Illiquidity is another concern because capital may be tied up for many years before realizing gains. Additionally, aggressive restructuring efforts often attract public and regulatory scrutiny, which can affect reputation. It's important to remember that returns in this space are earned through careful management and execution. They are not guaranteed. This approach is complex and best suited for those with relevant experience and a strong understanding of the risks involved. Distressed renewable debt acquisition isn't about charity, it's a practical necessity. When projects that are poorly structured fail, someone has to make tough decisions about whether those assets will deteriorate or recover. That responsibility falls on capital that is prepared to deal with insolvency laws, face operational realities head on, and apply discipline where optimism once took over. In today's landscape, where the push for energy transition meets hard financial realities, distressed investors play a critical role. They act as the bridge that transforms struggling green infrastructure into strong, productive assets, preventing potential risks to the entire energy grid. While good intentions may drive the creation of wind farms and other renewable projects, it is the more pragmatic, sometimes tough-minded capital that ensures these assets continue to operate effectively over time. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.